You can bankrupt a casino debt, a medical bill, even a mortgage, but not a student loan. $1.8 trillion locked behind a legal wall built piece by piece over 40 years. This is the story of how American education debt became the only loan with no exit door. In the next 15 minutes, you'll learn how student debt transformed from a dischargeable loan into a permanent financial obligation. You'll see the exact legislative steps that removed bankruptcy protections. You'll understand the mathematical incentives that turn education financing into a profit engine. And you'll discover why this system was not a mistake, it was architecture. Let's begin. Welcome to Financial Detective, where we don't predict the future, we reveal the pattern. In 1965, the Higher Education Act created federally backed student loans. The goal was simple: increase college access for middle and lower income families. The mechanism was standard lending. Borrow money, pay it back. If you couldn't, bankruptcy was an option. For the first decade, student loans functioned like car loans or credit cards. If a borrower faced financial catastrophe, they could file for bankruptcy and discharge the debt after 7 years. The risk sat with lenders. The system self-regulated through credit screening and loan limits. But by 1976, something shifted. The narrative changed. Media reports began surfacing. Young doctors and lawyers were supposedly taking out massive student loans, graduating, then immediately filing bankruptcy to erase the debt. The story spread quickly. Abuse of the system, moral hazard, taxpayer loss. Congress responded. In 1976, the first restriction appeared. The Bankruptcy Reform Act made federal student loans non-dischargeable for 5 years after graduation, unless the borrower could prove undue hardship. The bar was set, the door began closing. The 1976 law wasn't dramatic. It seemed reasonable. Wait, 5 years, prove genuine hardship if you needed relief sooner. Most Americans didn't notice. Borrowers were fewer. Average debt was manageable. The student loan market was small, contained, controllable. But the precedent was established. Once the principle of restriction entered law, expansion became inevitable. The 1976 law created a 5-year buffer. After that, discharge was possible. But the definition of undue hardship was left vague. Courts interpreted it narrowly. In practice, proving hardship became nearly impossible unless the borrower was permanently disabled or destitute. Then came 1990. Congress passed another amendment. Now, not just federal loans, but also private student loans made under certain programs became non-dischargeable. The wall extended. The reasoning? Consistency. If federal loans couldn't be discharged, why should private loans? The logic seemed sound. The trap tightened. In 1998, the wall grew taller. The Higher Education Amendments eliminated the 7-year discharge window entirely. Now, federal student loans could never be discharged in bankruptcy except under undue hardship. No waiting period, no time limit, forever. Each legislative change was presented as a technical adjustment, a minor tweak, nothing radical, but step by step, the architecture transformed. What began as a 5-year restriction became a lifetime obligation. By 2005, the cage was complete. The Bankruptcy Abuse Prevention and Consumer Protection Act ironically named extended non-dischargeability to all private student loans. It didn't matter who issued the loan bank, government, private lender. If it was labeled educational, it couldn't be erased. Let's pause here. In 30 years, student debt went from dischargeable like any other loan to the only form of consumer debt with near absolute bankruptcy protection. Why? What was the incentive? Who benefited from this transformation? The answer lies in risk transfer and market psychology. When a loan cannot be discharged, the lender's risk drops to near zero. Default rates become irrelevant. There's no credit screening pressure, no need to evaluate repayment capacity. The loan is guaranteed by law. This created a mathematical certainty. Lenders could issue unlimited volume with zero concern for borrower solvency, and they did. From 1,995 to 2,025, total outstanding student loan debt exploded from approximately $187 billion to $1.8 trillion. That's an 862% increase in 30 years. Compare that to wage growth in the same period, roughly 82%. The imbalance isn't accidental, it's structural. Colleges noticed. Tuition prices rose in lockstep with loan availability. Between 1,980 and 2024, college tuition increased by over 200%, while inflation rose only 236%. Why? Because students could borrow without limit, and schools could charge without restraint. The loan system removed price discovery from the market. Here's the cycle in detail. Congress makes loans non-dischargeable. Lenders issue loans without traditional risk assessment. Students borrow maximum amounts because access to education depends on it. Colleges raise tuition because demand is inelastic. Students will pay anything to attend. Administrative costs balloon. Colleges hire more administrators than professors. Amenities escalate. Luxury dorms, recreation centers, climbing walls. Debt grows faster than income because wages stagnate. Borrowers default, but debt remains enforceable. Lenders collect through wage garnishment, tax refund seizure, Social Security withholding. The loan never dies. The borrower is never free. The lender is never at risk. The college is never accountable. The system feeds itself. Now let's examine who holds this debt. As of 2024, the U.S. Department of Education holds approximately $1.6 trillion of the total $1.8 trillion. The federal government is the largest consumer lender in the United States, larger than all credit card companies combined, larger than all auto lenders. The government's balance sheet depends on repayment. Discharge would mean loss. The system protects itself by design. Private lenders and loan servicers, companies like Navient, Nelnet, and others also benefit enormously. They don't bear default risk, but they collect servicing fees on every loan. More loans, more fees. Longer repayment periods, more fees. The debt becomes an annuity stream. Predictable, reliable, profitable. Technically, student loans can still be discharged under bankruptcy if the borrower proves undue hardship. But this phrase has no statutory definition. Courts use the Bruner test, established in 1987 by the Second Circuit Court of Appeals in the case Bruner v. New York, State Higher Education Services Court. The Bruner test requires 3 conditions. 1. The borrower cannot maintain a minimal standard of living if forced to repay. 2. This condition will persist for a significant portion of the repayment period. 3. The borrower has made good faith efforts to repay. In practice, this standard is nearly insurmountable. Courts have denied discharge to borrowers who are homeless, disabled, elderly, or terminally ill. In one case, a borrower with a traumatic brain injury and an income below the federal poverty level was denied discharge because the court believed future income might improve. In another, a 65-year-old woman living on $1,000 per month in Social Security was told she hadn't proven sufficient hardship. The second prong that hardship will persist is particularly cruel. It requires borrowers to prove that their financial situation is essentially hopeless. Courts demand medical documentation of permanent disability or proof of chronic, incurable poverty. Temporary hardship doesn't count. Job loss, medical emergency, family crisis, none of these meet the standard unless they're permanent. Between 2005 and 2017, fewer than 500 borrowers successfully discharged student loans through bankruptcy out of millions of filings. That's a success rate below 0.1%. The legal exit door exists in theory. In reality, it's welded shut. Most bankruptcy attorneys advise clients not to even try. The cost of litigation often exceeds the debt itself. When borrowers default, the government and private lenders deploy aggressive collection mechanisms unavailable for any other consumer debt. Wage garnishment. The Department of Education can seize up to 15% of disposable income without a court order. No judge, no hearing. Administrative garnishment is automatic. For a borrower earning $40,000 annually, that's $6,000 per year taken directly from paychecks. Tax refund, offset. The Treasury Department intercepts refunds automatically. Expecting a $3,000 refund, it's gone. Redirected to loan servicers, no advance notice required. Social Security withholding. Even retirement benefits aren't safe. The government can withhold up to 15% of Social Security payments. Retirees in their 70 seconds, living on fixed incomes, see their benefits reduced every month for loans taken out decades earlier. Professional license suspension. Some states suspend nursing licenses, teaching certifications, or law licenses for defaulted borrowers. Can't work without a license. Can't repay without work. The trap closes tighter. There's no statute of limitations. The debt doesn't expire. It accrues interest indefinitely. Borrowers in their 60 seconds and 70 seconds are still paying loans taken out in their 20 seconds. Some die with the debt still attached. Federal loans are discharged at death, but private loans can pursue the estate or co-signers. Elderly parents who co-signed for their children's education find themselves hounded by collectors after their child's death. The system is mathematically self-perpetuating. Default triggers fees often 18% to 25% of the outstanding balance. Fees increase the principal, higher principal generates more interest. More interest leads to longer repayment. Longer repayment increases the likelihood of financial disruption, job loss, illness, divorce. Disruption causes more default. The cycle loops endlessly. This isn't a bug. It's the operating system. The debt is designed to be permanent. The enforcement mechanisms ensure compliance. The borrower is locked in a financial cage with no key. Every system requires a story. The story for non-dischargeable student debt was simple. Borrowers are abusing the system. The narrative emerged in the 1,970 seconds elite professionals exploiting bankruptcy to dodge repayment. But data never supported this claim. A 1,977 Government Accountability Office study examined bankruptcy filings and found that abuse was statistically negligible. Less than 1% of borrowers filed bankruptcy shortly after graduation. Most defaults came from low-income borrowers who never finished their degrees, or who graduated into recessions with no job prospects. Yet the narrative persisted. It was repeated in congressional hearings, media reports, and policy papers. The story became truth. And once the story was accepted, the legislative architecture followed smoothly. Politicians could point to abuse and justify restrictions. Voters didn't object because the story made sense emotionally, even if it was false empirically. This is how systems justify themselves, not through data, through story. The story creates permission for structural change. And once the structure is built, it doesn't matter whether the story was true. The system is already operational. The architecture is in place. The narrative fades into the background. The machine runs on. Today, 45 million Americans carry student loan debt. The average balance is approximately $37,000. But averages hide extremes. Over 7 million borrowers owe more than $100,000. Over 1 million owe more than $200,000. Many of these are not doctors or lawyers, they're social workers, teachers, graduate students in low-paying fields. Monthly payments consume 10% to 20% of income for millions of borrowers. Homeownership rates among student debtors are 36% lower than non-debtors in the same age bracket. Marriage rates decline, couples delay weddings because of debt, birth rates drop, parents postpone or abandon plans for children because they can't afford both debt payments and childcare. Entrepreneurship decreases. Starting a business is impossible when 15% of your income is being garnished. The debt reshapes life trajectories. It delays wealth accumulation. It prevents generational transfer. It locks borrowers into wage labor with no flexibility, no mobility, no room for risk. Income-driven repayment plans promise relief. Pay 10% of discretionary income for 20 to 25 years, and the remaining balance is forgiven. Sounds reasonable. But there's a trap within the trap. Forgiven debt is treated as taxable income. A borrower with $80,000 forgiven after 25 years could face a $20,000 to $25,000 tax bill in a single year. The escape hatch leads to another cage. Public service loan forgiveness was designed to help work in qualifying public service jobs for 10 years while making 120 payments, and your loans are forgiven. But as of 2021, over 98% of applicants were rejected. Reasons: wrong loan type, wrong repayment plan, employer not qualified, missing paperwork, payments not certified. The promise exists on paper. In practice, it's a mirage. Borrowers spend a decade believing they're on track, only to discover they never qualified. The system is functioning exactly as designed. Maximum loan issuance, minimal discharge, permanent collection, self-reinforcing revenue stream. The $1.8 trillion student loan system is not broken. It's performing exactly as engineered. Non-dischargeability wasn't a side effect, it was the core design feature. Remove bankruptcy protection. Eliminate risk for lenders. Increase loan volume without concern for borrower capacity. Inflate tuition because demand becomes inelastic. Lock borrowers into lifelong repayment with no legal exit. Enforce collection through wage garnishment, tax seizure, Social Security withholding, and license suspension. Ensure the debt never dies. This is mathematical determinism. Every step was deliberate. Every restriction intentional. The system doesn't need to be fixed. It needs to be recognized for what it is, a debt architecture built to be permanent, profitable, and inescapable. So here's the question I'll leave you with. If every other form of debt can be discharged, gambling debts, credit cards, mortgages, medical bills, why should education be the exception? Drop your answer in the comments below. If this breakdown changed how you see the system, hit subscribe. There's more architecture to expose.